The yield curve inverted for the first time in July of 2022, so it has been more than a year. When the yield curve inverts, we are either in a recession or not far from a recession. And we would say we've been in a rolling recession for the past year and a half. And we think that it is a harbinger of much slower economic growth and lower inflation than most people believe.
Today, we have the latest interview with the CEO of ARK Invest, Cathie Wood, providing us with a market update for the end of 2023. According to recent reports, Federal Reserve policymakers are determined last week to keep their benchmark interest rate around 5.4%, the highest level in 22 years. Reserve officials did not raise the rate in their previous meeting either, but they maintain that future rate hikes are possible if inflation accelerates in the coming months. Officials are cautious about declaring an end to their efforts to combat persistent inflation. The central bank aims to avoid repeating the mistake made in the 1970s, when premature easing of inflation control led to a resurgence of double-digit price increases. The Federal Reserve Bank of San Francisco emphasized that it is too early to claim victory over inflation. However, investors have begun speculating that tighter financial and credit conditions for households and businesses are likely to weigh on economic activity. These expectations have driven stock and bond prices higher, indicating market confidence in the Fed's intentions. Let's check out the latest interview with Cathie Wood, as she talks about her outlook for the end of 2023 and what economic indicators we can expect concerning inflation, the stock market, and the potential impact of cryptocurrencies on the global monetary system.
The government may shut down in mid-November. We do have a new speaker in the House, but there is still partisan saber rattling, or they may get a continuing resolution so we don't have to deal with this over the holidays and move the debate into January. It's just becoming de rigueur now, and I think investors are getting used to it. They don't like it, nobody likes it, but it is what it is. The other thing that happened actually this week was an executive order on artificial intelligence, which we think can be described as serious overreach and certainly favors the incumbents and we think would really hurt innovation. So it is an executive order. We do think that both Bitcoin or crypto or digital assets and artificial intelligence now could become part of the election year debate. The federal deficit as a percent of nominal GDP since the late 60s. And I remember in moving into the business or coming into the business in the late 70s, early 80s, during the Reagan administration, when the deficit hit 5%, there was hell to pay. I mean, both sides of the aisle were up in arms. Now, it happened because of back-to-back recessions, you can see in the shaded lines there. And as Federal Reserve Chairman Paul Volcker was slamming the brakes on money growth. And so we had a difficult period. And typically the deficit does go up during difficult periods, recessions in particular, because of what we call contra-cyclical spending. This is what government is supposed to do, provide a safety net. Well, you can see what's happened since then. We're now supposedly without a recession. We're at roughly 6% as a percent of GDP, the deficit is. And so the question is, oh my goodness, what would happen in a recession? Well, you saw what happened in COVID. During COVID, that's where contra-cyclical spending really kicked in. And so we're back roughly to where the deficit was pre-COVID. Now, as many of you may know, we believe we've been in a rolling recession for the last few years, and we'll get into that with more charts. So maybe this spending and this deficit is more contracyclical than many people think. And we learned from the early 80s that the best way to get out of a deficit like this is to have very rapid growth. So you'll look at the 80s and 90s. We had spectacular growth. Technology was coming of age. Inflation and interest rates were coming down. And you can see what happened to the deficit. It turned into a surplus during Bill Clinton's administration. And we think that could happen again. So we are not as negative about the deficit, although we do believe that the spending programs that have been put in place in the last couple of years after the initial COVID spending have been overdone. And as I've mentioned in prior in the nose, government spending is taxation of one form or another. It will turn into taxation, whether actual taxes to try and cure it, or in the case of a rapidly growing economy, the taxes that go with that would be a good solution, or inflation. And many people look at what's going on now and say, this is a recipe for inflation. The way to get out of debt is to inflate it away. We don't think that's going to be the case. And we'll get into a few indicators in a moment that support our view that actually the risk is not inflation moving forward. It is deflation.
Cathie does believe the current monetary policy also raises concerns about inflation rates. The potential rise in real interest rates could impact investment decisions in the last part of the year, making investing in alternative assets like Bitcoin and other cryptocurrencies more attractive due to their inflation-resistant properties.
Chairman Powell this week, during his comments after the board meeting, I think he had an inkling that the employment reports this week were going to be weak. I think he probably had a sense of initial claims. They went up. But also perhaps an early read on the employment report, which today was very weak. And one of the reasons it is so weak is this chart. So this is money growth, M2 growth on a year-over-year basis, going back into the 60s, early 60s. And you can see we've never seen a decline in money like this in this period of time. You have to go back to the 1930s, which of course was the Great Depression, to see a decline in money like this. Now, this is the other side of what happened during COVID. So it's it's understandable to some extent. But now we're soon going to be lapping one full year of negative money. And so the course correction has taken place, we believe. If money doesn't pick up, then what we will conclude is it's becoming a serious drag on the economy. And deposits are leaving the system. The regional banks still are losing deposits. That's part of the decline in money. And that's not a good thing. In fact, the KRE Regional Bank Index is revisiting its March lows when we were in a crisis around the regional banks. So the regional bank index is a warning that Fed policy has just overdone it here. We hope it doesn't break down the index. And it is possible that some of the numbers coming out now are making the case for a Fed pivot so clear that the regional banks will not face as stiff a competition from money market funds and will be able to attract deposits again. So this is M2, still declining year over year. And here is the yield curve. Now, we've talked about the yield curve here many times. Here's the picture going back into the 70s. This is the 10-year Treasury yield minus the 2-year Treasury yield. And when it's below zero, it means that short-term interest rates are higher than long-term interest rates, which is not normal, as you can see from this chart. And you can also see that typically when the yield curve inverts, we are either in a recession or not far from a recession. And we would say we've been in a rolling recession for the past year, year and a half. The yield curve inverted for the first time in July of 2022, so it has been more than a year. And we think that it is a harbinger of much slower economic growth and lower inflation than most people believe. The other point we like to make about this chart is, to see a yield curve going down to -1 or -1% or 100 basis points, just like it did in the early 80s today, is quite something because the base of rates is so much lower. So today we have the long bond yield in the 4.5% to 5% range. Back in the 80s, that number was 15%, and yet we have had the same degree of inversion here. That tells us that monetary policy today is much more stringent than it was even in the early 80s when interest rates were at 15%, because 100 basis points on 4.5% to 5% is a lot more dramatic than 100 basis points or 1% on 15% interest rates. So we think monetary policy is much tighter than many understand.
Cathie Wood's main focal points this year has also been the movement in crypto legislation in the House, signaling the growing interest in the crypto space. Although crypto legislation might face challenges due to political opposition, Wood advises the company in which she invests to spend heavily now in order to take advantage of huge growth potential. She estimates that ARK's concentration on technology advancement is worth about $7 to $8 trillion, or less than 10% of global equities markets. Emerging markets are relying on digital currency, and Cathie believes that based on the current market outlook, decentralized finance will take over and usurp the roles of most financial services companies. Today, they'll be able to offer lower rates to savers and higher rates to borrowers. In a surprising turn of events, the US Treasury made waves in the financial markets on Wednesday with its unexpected announcement. Investors, who had been bracing for a more substantial increase, were pleasantly surprised as the Treasury revealed plans to boost government bond sales in Q4 2023 by a margin lower than anticipated. This revelation triggered a significant and dramatic 20 basis points drop in US 10-year yields. Market experts and analysts were left in awe as they witnessed this unexpected shift, which sent shockwaves throughout the financial world. What do you think of Cathie Wood's interview on the current financial market? Comment down below. Thanks so much for watching. Don't forget to hit the like button and subscribe for more content just like this. We'll see you in the next video.